morning, everyone. I'd like to welcome you to our session this morning on flood insurance. My name is Lisa Sherrard, and I will be your moderator this morning. I'm very eager to hear what our speakers have to share about the private flood insurance market and the upcoming NFIP rating changes, as well as how the Flood Insurance Advocates Office has had a huge impact on bridging the gap between the consumer and the NFIP program. At this time, I'd like to thank Stantec for their sponsorship of this session today, and I'd like you to join me while we learn a little bit more about this company.
Good morning, everyone. My name is Mark Pearson, and I'm a senior principal at Stantec. I'm very excited to welcome you to this morning session and the 2021 ASFPM National Conference. Stantec is a very proud and long-running sponsor of the conference, and we're just so excited to be here again this year, even though we can't be in person. I'm very disappointed by that, but extremely hopeful that we'll all be able to get together next year. Stantec, like I said, is very proud to be associated with ASFPM, and we have a lot I have a lot of my colleagues that are both presenting this year and helping to moderate some of these awesome sessions. So I hope that you enjoy this conference and get the most that you can out of it. I know there's a lot changing in our industry, so enjoy the conference. And if you have any questions about Stantec or what the services we can provide, please come visit our digital booth in the Exhibitors Hall. Have a wonderful conference.
Thank you, Stantec, for your sponsorship of this event today. Our first speaker is Bruce Bender of Bender Consulting. Bruce is no stranger to us, as the long-standing chair of the Flood Insurance Committee. He has the evolution of private flood insurance market, a look at the past, present, and future to share with us today. Bruce?
Great, thank you, Lisa. Appreciate the introduction. And we're going to do things a little different than what you've seen at some of the other sessions. I'm going to talk about the evolution of flood insurance, take a quick pause, and then we're going to segue right into then what is FEMA doing in this world as the world transforms or the flood insurance world evolves. But first, let's take a look at in the past a little bit about flood insurance. As most of us know, homeowners, we've been saying for a long time, homeowners insurance doesn't cover damage due to flooding. You got to get that single peril policy from the NFIP. But as things change, we can't say that. Now we have to say most homeowners insurance policies don't cover because we're seeing the marketplace change. But before I move on, let's go back. Let's go back to those 70s. Remember those trend-setting 70s? Those bell-bottom pants, those shirts, like on the right, that if you got too close to a flame, they might melt. And yeah, I had one or two of those as well. And think about back in the 70s, the TV shows, Goodnight John Boy, Mary Tyler Moore, The Jeffersons, and the iconic MASH. Fabulous shows. But let's keep going back to the 70s and take a look at the tech. The technology cutting edge back then was like this HP calculator that could do sines and cosines. I had no idea, but I wanted to have that because it could do that. Didn't know what to do with them. The quote personal computer. Remember the telephone? The cell phone, it was a brick. And remember the games? Think about the games we have today, and the game back there, Pong. You just watch this little thing go back and forth, and back and forth, and move your paddle up and down. That's what was going on in the 70s when the NFIP rating system was put together. And while technology and fashion and TV shows trends have all changed and improved, we're still rating the same way with the NFIP as we did 40 years ago. So today's NFIP, as we know, is a complicated product. Over probably 100 questions that you could ask. The basement coverage for those who do have basements in their areas is limited coverage. The NFIP FEMA has to write all properties. There is a very limited cases where you can get replacement costs as opposed to your homeowner's coverage. The limits have not increased in a long time, and they have subsidized and grandfathered rates. In homeowners, you don't have that. If the house was rated based upon how close the fire station was, and due to budget cuts, the fire station now is closed, they don't keep rating you as if the fire station was open. But yes, with grandfathering, you can in flood. And there's these fees and now a $250 surcharge. That's today's flood insurance. And taking a look at today's flood insurance, we've got a large flood insurance gap. The Congressional Budget Office expects that floods cost up to $20 billion each year, but only 16% of that is covered by the NFIP. So of about the 4.8 or so million residential policies, that represents only about, back in 2018, about 15% of the US households. So that's 5 out of 6 homes that aren't covered. And per Swiss Re, they say that's about a $10 billion gap. In fact, Mr. Marstead said yesterday that only about 4% of the US residents have flood insurance. And those in high hazard areas, it's only about 30%. Yet 99% of the counties in the US have experienced flooding. That's a huge insurance gap, so big that FEMA has identified that in their 5-year strategic plan. One that the NFIP needs help filling. Enter in private flood insurance, a marketplace that Milliman estimates is $34 to $48 billion. So back in the days when I used to run a write your own flood insurance program in my division, we decided we wanted to do something a little different. We decided to create a program called excess flood insurance. And so I went out to the marketplace. We didn't have Google search as good as we have now back then, and identified in the process of doing that, there was about 10, maybe 12 carriers that wrote flood insurance from $0 in the residential side. Then it kind of waffled like that amount, because I did this every 2 years and presented at the National Flood Conference and updated and shared and got feedback from others as I heard other programs. And then all of a sudden we had reform legislation and the rates started to go up, and boom, we suddenly went from 10 to 12 carriers to over 50. In fact, over 60 carriers. And that's in programs. That's not different agents. That's different programs out there today. They're basically written 2 ways. One is known as admitted, which means the carrier submits, or the insurer submits, their paperwork, their rates, their policy form, and it gets approved. And by being an admitted carrier, then if they happen to ever go belly up, there is a state guarantee fund that will pay for claims that couldn't be paid since the carrier was bankrupt. But most catastrophe coverage is written under what's called non-admitted coverage. And that means they don't have to file their rates. They don't have to file their policy forms. They do have to financially still be approved to write insurance in the state. However, they don't have access to that state guarantee fund. But they have the flexibility of rates. And with catastrophe coverage, in the past, we don't have a lot of data like we do with the homeowners and auto, compared to like with earthquake and floods, which happen and then don't happen again for a while. Though we've seen, unfortunately, floods happen a little more than we'd like. What also has driven the marketplace is new technology, new ways to identify the properties, the hazards around your house, whether it's wildfire, flood, or whatever. In our case, flood insurance. A lot of data is now out there, or they use artificial intelligence to help identify the risks of hazards. And then the question back then was, well, I got to make mine compliant for the lender to accept it. So it has to be as broad as the NFIP. Well, I'll talk about how that has improved. And speaking as broad as, we're finding these programs are actually broader than the NFIP. They're offering a lot more. So speaking of the lender acceptance, the July 2019, they came out, the lending regulators, with guidance on how a lender would accept and needs to accept private flood insurance. They're going through some Q&A right now, questions and answers that they're trying to write and get feedback on. The only one that didn't was FHA. They are also now trying to get a proposed rule approved and through the Federal Register, and then they'll have guidance for them as well. So by having that guidance, now lenders are a lot more comfortable in accepting private flood to cover the loan. And from the state perspective, Insurance is a program or product that's regulated at state level, not the government level. And the National Council of Insurance legislature have come up with a model act to help states encourage private flood to come in. The National Association of Insurance Commissioners also have provided guidelines for insurance companies and states to follow to come in right in a state. And it's happening. We're seeing Iowa, Massachusetts, Louisiana, unfortunately, has come up with their own. They didn't quite follow the regulations. South Carolina, where Lisa is, has come up with legislation for it. North Carolina's come up with their own program. So we're seeing more and more states, with Florida being the lead, and then Pennsylvania, some others, really encouraging and finding ways to make it easier for states to, for carriers to come in and write private flood. So the typical type of flood policies that we're seeing out there, and these are Bruce Benderisms, these are not technical insurance terms, is the NFIP Me Too. And that was what was out there at the very beginning, back in the 90s when I first did my analysis. And it's basically what it says. It's the NFIP policy, and they just take off the name and put in the name of NFIP and put their name in. Otherwise, it was all the same. They gave a discount on the rates. What's also been out there for a while is called differences in condition, DIC. And a DIC policy basically is one that says, all right, your homeowners is not going to cover earthquake or flood. Well, we will get Lloyd's in this case to cover those differences in perils that aren't covered. And so those differences are covered in a DIC policy. And so flood is not a single peril, but we'll have other ones as well. We see a lot of this out in the Southwest area being written and have been since the 90s. Then there's one I call Homeowners Plus. And that kind of goes back to my first slide of most homeowners that we now have to say. Why? Because we saw in the early 2000s, some of your high-end homeowners starting to offer flood coverage in the low to moderate risk zone areas, B, C, and X, as part of their homeowners. And we now see some actually homeowner carriers also offering flood insurance. But one we see a lot now is called the NFIP Plus, or what I call it, where they're taking the NFIP policy and adding on additional coverage. Now, it has to be as broad as if they want the lender to accept it, but then adding on coverages. So what are those different coverages? So we're seeing, for example, limits increase from the 250 that for a home that we have for the NFIP, $5 million for building, $2 million for contents was kind of an average we saw out there. TIV is total insured value. That means they combine the contents and the building together and then use that total amount to pay claims on either building or contents. Really, so much higher coverages. Then we've seen replacement costs being offered by a lot of the programs on buildings, not just single family residence or principal residences like it is with the NFIP or RCBAPs. We're talking all building types and even on contents. With the NFIP, you can't say, I don't want coverage anymore. Private programs, many of them, if not most, you can say, yeah, I don't want it anymore. Now, the concern is it'll become a seasonal policy. Gulf Coast, East Coast, we're gonna buy it, in May and cancel it in October. But my conversations with insurers and different program managers has been that they're not seeing that. Now, I haven't talked to all 15, 60 or so of them, but we're not seeing that. What happens is the carrier will prorate it, which means, okay, we had it in place for this amount of time of the entire 12 months, so we're going to get premium to cover that. But other than that, we'll return the rest of your money. And the waiting period is much shorter, if not at all. We're seeing zero, a lot of zeros, some fives, a couple sevens, some go up to 2 weeks, but limited waiting period, if any, and providing additional coverages. Now, with your homeowner's coverage right now, if you have a fire and you have to live in an Airbnb or apartment or hotel or whatever for a month or whatever, most homeowners policies will provide what's called additional living expense, not the NFIP. The NFIP does not provide business interruption or additional living expense. If you want something like that on ALE equivalent, you'd have to file for individual assistance. And so it'd have to be a presidentially declared disaster. But here on the private, we're seeing that offered on a lot of them. We're seeing expanded basement coverage A couple carriers now, it was one now, a couple of them have what's called flex cash. Here's $10,000. Use it as you want. Clean out the yard, stay at a hotel, whatever. Help yourself recover that fits best for you. And in fact, we're even seeing some having a swimming pool clean outs as well. So these are broader additional coverage. So it's making it a lot more attractive. I'm staying away from price, but price in many areas, price competitive, but also offering more than what the NFIP has and offering the quotes more quickly. Right now, Tony will talk about how that's changing, but right now, to get a quote, if you're in a high risk area, the agent's going to ask you, do you have, what zone are you in? Okay, I'll look it up. Okay, you don't know. Okay, now, do you have an elevation certificate? An elevation what? Well, what's that? Well, you got to go out. How do I get that? You hire a surveyor. How much is that going to cost? Oh, well, $500, $1,000, depending where you live. Wait a minute. I got to pay somebody to give me a document of $500 before you can give me a quote? With private flood, here are two examples that I pulled off the internet. My mother-in-law's house in Florida, she lives on a canal. So I know she's in a zone A, but I don't have her policy. But just knowing her address and her house, I was able to quickly put in and get two different quotes just by either the drop-down boxes or those little toggle switches. That quick, I mean, literally seconds went by. So it all sounds great. It all sounds like, why wouldn't I want to write this? Why wouldn't I want a private flood policy versus the NFIP? Well, first is to consider lapses. If you have a policy and you go to the private market and 2 years later, let's say, the price gets too expensive or the carrier decides, I'm not going to write you anymore and you can't get coverage anywhere else. And this happens sometimes when you have big storms, they tighten up how much carrier will write because they don't have to write everywhere. You go back to the NFIP, that counts as a lapse. So if you're pre-firm, if you are rated newly mapped or pre-firm grandfathered, you will lose that rating and you'll have to be rated according to what the new map says, or with, as you hear about risk rating 2.0, whatever risk rating 2.0. So you lose all of that benefits of the subsidized rates, et cetera. 30-day waiting period, it applies. Why? Because you don't have a lender telling you you need it. You made the conscious decision to move the market. And finally, if it's not admitted, which a lot of the programs are, and just to give an example, I'm not pushing this, Lloyd's is a non-admitted carrier, you don't have access to the state guarantee fund. So if that carrier goes belly up after a big storm and can't pay the claims, you're SOL. So these are things we encourage agents to tell and discuss with their clients. And we'd like to let you know as floodplain managers, if somebody asks you about it. But let me just share with you a little things of ASFPM's concerns as well. First is cherry picking. I don't know if you can see on my screen the little stormtroopers picking cherries, but the concern is that the private market will take the good stuff and leave the NFIP to be the market of last choice. And if that happens, then the rates will really take off potentially, and then we have even a worse affordability issue. I will tell you from my personal experience, I've actually sat in the box, as they call it, in Lloyd's in London and watched them underwrite, and several that I saw were where the lowest floor elevation was negative, was below the base flood elevation by 4 feet, one of them. And I said, well, why are you writing this stuff? It's got a lot of, quote, if you will, hair on it. They said, actually, we like that. One, you can get a good premium. We think we can underwrite it better than the NFIP can. And we don't have to take it everywhere where NFIP has to. So we will not load up or have concentration of risks in different areas. So yeah, maybe up here, this part of the coast will get hit, but down here, hopefully it won't, or inland it won't. So we can spread our risk a lot better. And so, in fact, so we're not seeing the hairy ones all being left behind. And we're seeing a lot of those carriers not taking the ones that are competitive with PRP. Why? Where are a lot of floods happening? Look at Harris County, Baton Rouge, et cetera. We're seeing Mother Nature having storms that are bigger than the 1% annual chance, and therefore those PRPs are being hit hard, so hard that we're seeing 15% annual increases in their rates at the NFIP. Speaking of the NFIP, if more and more policies move, but not just add to, but move over to the private, that means less policies of the NFIP, and the NFIP policy, federal policy fee, pays for grants program, helps pay for the mapping, and helps pay for the NFIP itself, the flood insurance program. So where's that money going to come from? So yes, we need to have private flood to help close the gap. But if the NFIP doesn't grow as well as the private market, then where's that money going to come from? Severe repetitive loss properties. My co-chair, Steve Samuelson, ASFPM Insurance Committee, shared a story with me a couple summer ago where a farmer out in Kansas actually had 3 losses. On the third one, he said, "Steve, make me an SRL. I got to mitigate. I got to do something about this." And unfortunately, he couldn't. Why? Because the first 2 were a Lloyd's policy, and they don't apply to severe repetitive loss calculations, determinations. So keep that in mind. And speaking of which, the other one it doesn't apply is benefit cost analysis. I was down post Maria in Puerto Rico talking to one of the NFIP state coordinators there, and he told me about how he applied for a grant and didn't get it because it didn't pass the benefit cost analysis, the BCA. Why? Because down there were 2 large private flood programs that moved a lot of the NFIP policies over to their market, and that left very few in his community, and therefore there wasn't a benefit to the policyholders because he didn't have many. So that is a potential. And finally, one that I hear some ASFPMers raise is, well, if so many people go to the private market and the private market does not use a community rating system in their rating, then does that mean more communities will not be encouraged to join because there isn't a benefit for their citizens, monetarily speaking? Or will there those who decide it's not worth the paperwork to keep it going and drop off because they see the policy count drop? Hopefully not. Hopefully they understand that CRS is a program more than just the discount, but that is another concern and consideration that's been raised. So I know we had said we would go on to Tony next. So I'm going to stop you to hold questions until then. We kind of race through because I know you all are really waiting to hear what Tony has to say, because this is what the private market is doing. But what is FEMA doing about that? Now, we were going to ask you a poll question, but we understand there aren't poll questions. So you might just take a look at the question we have here to help enter in, Tony. I know you didn't see this coming. Risk rating 2.0 is now being known as a doggone new way to rate, a new day, a new way, equity in action, or Hake's way, or the highway. And with that, I'm going to go on mute, which Tony probably wish I had a little while ago, and move on to Tony's presentation.
Thank you, Bruce. Good morning, folks. Hopefully you can all hear me. I didn't know about Bruce's little question, so that's a surprise. But yeah, it's great to be here today. As Bruce said, I'm here to talk to you about the NFIP's new pricing methodology called Risk Rating 2.0, Equity in Action. FEMA still wants to emphasize that we believe the best defense against flooding for all property types is insurance. Following today's conversation, I hope you folks will help us amplify what you hear to advance the mission and reduce disaster suffering by closing the insurance gap. So Equity in Action is a transformative effort that will help FEMA achieve its mission and pursue equality in pricing for all of our policyholders. As you are well aware, rates already increase under the current NFIP rating methodology. Respectively, under Risk Rating 2.0 Equity in Action, rates are going to increase for some policyholders, and then rates will also decrease for some policyholders. I'll talk to you a little bit more about that later in my presentation. Policyholders who will see increases under the new NFIP pricing plan fundamentally differ from the rate increases under the current methodology. So as we compare the two methodologies, as you're well aware, all NFIP policyholders under the current system pricing method are subject to premium increases every year. In fact, from 2018 to 2021, the average annual premium rate increase was around 10%. These yearly statutory increases under the current system occur year after year without any end in sight. So, however, under the new pricing methodology, the rate increases will not continue indefinitely. So once a policy reaches its full risk rate, the increases stop. So it's very important to note that the new plan will comply with all statutory and regulatory requirements, including the premium caps currently in place. So under Equity in Action, about 2/3 of the older homes, which are currently paying some of the highest rates in the NFIP, will see some premium decreases. I don't know if you were in David's plenary yesterday, he emphasized that as well. So since the 1970s, you've heard Bruce say it, you've heard David say it, and you've heard others say it over the years. Rates have primarily been based on rather static measurements, emphasizing a property's elevation within a zone on the flood insurance rate map. This approach, however, does not incorporate as many flood variables as the new methodology. As such, the new methodology is not a minor improvement, but a transformational leap forward. Under the new methodology, FEMA now has the capacity and tools to address rating disparities by incorporating more flood risk variables like flood frequency, multiple flood types from river overflow, storm surge, coastal erosion, heavy rainfall, distance to a water source, along with characteristics such as elevation and the cost to rebuild. Now that the new methodology takes into consideration the cost to rebuild, FEMA will be able to equitably distribute premiums across all policyholders based on their property's unique risk. And I'll emphasize that, based on the property's unique risk. Equity in Action builds on years of investments in flood hazard information by incorporating private sector data sets, catastrophe models, and evolving actuarial science. This includes using existing FEMA mapping data and NFIP policy and claims data, along with other federal government data from the USGS, NOAA, and the US Army Corps of Engineers. In addition, third-party commercially available structural and replacement cost data, along with CAP models, is incorporated into the new analysis. Equity in Action will address the inequality in the program that has built up over time and must be corrected. Policyholders with lower value homes are paying more than they should, and policyholders with higher value homes are paying less than they should. The new pricing program enables FEMA to set rates that are fair, ensures that rate increases and decreases are both equitable. As previously mentioned, 2/3 of older pre-firm homes that have some of the highest rates in the NFIP today under the current methodology will see an immediate decrease in the cost of their insurance. The new rating methodology has exposed these inequalities, and we can't turn a blind eye to the policyholders who have been unjustly subsidizing other policyholders for years. Since our rating methodology hasn't been updated in more than 40 years, it's not fiscally sustainable in its present form to withstand the frequency and intensity of recent events and storms. So what's not changing? So Risk Rating 2.0 in Action is transformational, but it's not changing every aspect of the NFIP. We're upholding all the statutory requirements. As I mentioned before, limiting annual increases or premium increases, staying within the statutory caps of 18%. We will continue to use the flood insurance rate maps for mandatory purchase and floodplain management. We will continue to offer premium discounts for pre-firm subsidized and newly mapped properties, as well as policyholders will still be able to transfer their discount to a new owner by assigning their flood insurance policy when the property ownership changes, and discounts for CRS will continue. However, since Risk Rating 2.0 does not use flood zones to determine flood risk, the discount in CRS communities will be applied uniformly across all policies throughout the participating community. And that is regardless of whether the structure is inside or outside the special flood hazard area. Now let's take a quick look at the national analysis for structures in the NFIP book of business. As you can see, the data tells us 23% of all current policyholders will see an immediate decrease in their premium. This is substantial. On average, there will be an $86 a month in decrease for policyholders, or these policyholders, or $1,032 a year. And these increases are, or these decreases, I apologize, are immediate. That doesn't happen under the current rating methodology, as you're well aware. They just continue to go up for every policy, regardless of their flood level risk. For the next two categories in the blue buckets, it's important to understand that under the current methodology, all policyholders have been seeing an average annual increase of $8 a month. That's under the current process. Under the new pricing methodology, 66% of the policyholders will see a 0 to 10% a month increase in their premiums. The overall impact on these policyholders is relatively neutral in year one. They essentially break even compared to what they pay now. Another 7% of our policyholders will see an average of $10 to $20 a month increase, which is somewhat more than what they are paying under the current rating system. The analysis shows that under the new pricing system, we've eliminated the steep and sharp increases that had caused a lot of uncertainty with policyholders, agents, congressional individuals as well. Finally, the gray bar, the 4% of the NFIP policyholders, they will see a $20 or more increase in their monthly premiums. These policies cover high-value homes in high-risk areas, and currently the lower value homes subsidize these properties. It is also important to remember that the statutory caps on annual premium increases stay in place under equity in action. So for this group of policyholders, it could be 10 to 15 years, a glide path before they reach their true risk rate. So looking at a high level, what does this change mean when compared to the current rating system? In year one, at their next renewal, 82% of the single-family homeowners will see monthly decreases or increases of $5 or less per month with risk rating 2.0 compared to the current system. So 82% of the single-family homeowners will either see a decrease or an increase of $5 a month or less. In year one, at their next renewal, 94% of the single-family homeowners will see monthly decreases or increases of less than $10 a month under risk rating 2.0 compared to the current rating system. And once again, remember, under the current rating system, policyholders do not see decreases, premium decreases, they all increase. So one thing I want to take a little dive into, replacement cost value, or RCV, is a key factor in creating equitable pricing methodologies. Here is why that's significant. Under the current rating system, 45,000 policyholders will see increases of more than $100 a month. The single-family homeowners in this group have an average replacement cost value of $399,000. So I want to emphasize that again, under the current rating system, 45,000 will see increases of over $100 or more a month. And the RCV for that group is just under $400,000. However, under risk rating 2.0, the number of policyholders drops to 3,200 who will see increases of more than $100 a month. The single-family homeowners in this group have an average replacement cost value for their structure of $1,064,000. So under risk rating 2.0, that number drops to 3,200 that will have an increase of over $100 a month, but the RCV for that population is over $1 million. So even policyholders paying the most today will see quite significant and immediate decreases when they transition into the new methodology. And you say, why? We'll get into that shortly, but broadly, over 1 million policyholders will see decreases under the new risk rating methodology. This includes over 600,000 single-family homes. So at the extremes, 3,000 single-family policyholders pay premiums above $12,000 and up to $45,000 a year under the current system. Again, under the current rating system, these premiums would continue to increase year after year. However, under the new plan, there is an upward bound that limits costs on the highest end of the spectrum. This means that no single-family home policy transitioning to the new Equity in Action Risk Rating 2.0 will see a premium of more than $12,125. So FEMA is taking a phased approach in implementing the new pricing methodology. For phase one, as you can see, any new policies beginning on October 1st, 2021 will be subject to the new pricing methodology. Also, beginning on October 1st, existing policyholders will be able to take advantage of immediate decreases in their premiums, will be able to enter into the new pricing methodology. In phase two, which is April 1st, 2022, all the remaining existing flood insurance policies will be written under the new plan. So FEMA investments span across time, people, and technology. Our initial research began in 2016 with the design and analysis, beginning shortly after that in 2017. From 2018 to 2019, FEMA conducted analysis and laid the foundation for transitioning to the new rating system. And then in 2020, the rates were actually finalized and system development began, involving federal program staff, insurance agents, and companies. Recognizing that we don't exist in a vacuum, the rating team consulted and engaged industry experts, scholars, subject matter experts, policyholders, trade groups, and our partners in the Government Accountability Office. We relied on state-of-the-art technology and the best available data to create a modern-day rating system that builds and expands upon years of scientific developments, actuarial data, and environmental analysis. CAT models are the backbone for this new rating structure. The NFIP licensed 3 sets of commercial catastrophe models: ERA Worldwide, CAT Risk, and CoreLogic. In addition to the commercial flood models, FEMA developed 2 additional models based on government data. These models are the Mapping Data Integration, MDI, and Probabilistic Flood Risk Analysis, PFRA, both of which have been historically used by FEMA in regulatory flood mapping. Additionally, we have also incorporated other federal agency data from NOAA, slosh modeling, tide gauge data, and the USGS gauge data and hydro high-res data set. And then we blended these models, both from government and commercial entities, to ensure the most accurate flood risk rating that FEMA has ever produced. It is also important to note that we work closely alongside our U.S. Army Corps of Engineers to provide an extensive review of our final methodology, including our understanding of the analysis of levies. I encourage anyone with questions to visit our Equity in Action website at fema.gov/NFIP transformation for more information. There are many resources there for you to explore, including the National Flood Rate Analysis, the rating fact sheet, state profiles for every state and territory in the District of Columbia, risk rating methodology and data source information, premium calculation worksheet examples, and rating factors. We will also soon be adding additional data on additional data mined down at different aggregate levels at possibly zip code level and county level. So the NFIP hasn't had a change like this in over 50 years. The new pricing methodology puts us on the path towards more financially sustainable program that is accountable to taxpayers and more accurately reflects the flood risk and helps individuals recover after disasters. That's it, Bruce.
Thank you, Tony. If I
You're
can
welcome, Lisa.
get Bruce to come online again, I'm going to ask some questions for you. that the panelists have, or the attendees have asked. Tony, this looks like a question for you. In the risk rating 2.0 methodology, you state that one of the rating variables is first floor height. Is this different than lowest floor height as defined by FEMA? And if so, what is the definition of first floor height?
So I believe it is different than lowest floor height. It's the first floor, habitable floor in the building that is used. So the first floor, that is the first floor height, and the difference between that first floor height and the ground that surrounds the structure is what's important under risk rating 2.0. I think I answered the question.
Yep, very good. I thought under, Sarah says, I thought under the current rating methodology, rate increases stopped at actuarially anyways, example using the EC or pre-firm increases at the point due to inflation, market fluctuations, et cetera. Are you saying 2.0 rates are capped, that cap don't take into account those increases?
The caps do have some of those increases. So, you know, that type of stuff continues under risk rating 2.0, but under risk rating 1.0, the rates continue to increase because we didn't have a full understanding of the full risk. So they just continued and continued and continued. Under risk rating 2.0, we know their full risk rate. And once they meet that, then they stop. But there are other parameters come in, inflation and all those types of things continue to come into play. Yes.
Very good. Tom wants to know, is there any discussion on communities having access to the back-end data from the models developed for risk rating 2.0?
So like I said, the information regarding the actuarial science is posted on site or on our site. They can look at that. The data, much of which is proprietary, we cannot release. So, you know, those models that we had actually procured, we cannot release those. So.
Since there is movement towards, Matt wants to know, since there's movement towards the graduated flood risk zones, will this be incorporated into insurance pricing?
I'm not quite sure I understand the question. I'm sorry.
I think what they're trying to say is, you know, are the maps going to be changing, looking at graduated risk rather than going in or out? You know, we're incorporating it into the pricing for flood insurance, but will they, is the mapping program going to change to match what we're looking at for insurance?
Yeah, and I believe there's another topic on the future of flood risk mapping that's coming up that folks can join. Some of that data, I don't know all the information about the future of flood risk mapping and what they're doing there. I should, but I don't. I know they're looking at how the mapping program can be modified, but I don't know the answer to that question.
Very good. Somebody's asking, Jen wants to know if the built-in compliance grandfathering practices are going away. So in other words, you can grandfather for either continuous coverage or building compliance. Is the building compliance grandfathering going away?
And Bruce, I'm looking to you. We answered this before and I'm drawing a blank.
So
do you remember what I said before?
Yeah, I believe what's happening is that certain grandfathering ones will start going up to full actuarial rate is what they're going to be headed for. But it's the newly mapped that and the pre-firm subsidies that are, and you say it better than I do, that are in the legislation.
Yeah, so
right.
Yeah, statutory requirements for pre-firm and newly mapped stay in place. The others will go on a gradual increase. You're correct. Sorry. Thanks for jogging my memory.
All right. And Lisa would like to know, not me, but another Lisa would like to know, when will floodplain administrators receive the local data for their community on the level rate analysis? We've got it at the federal level, at the state level, but they want to know if they're going to get it at the local level.
So I know FEMA is currently in the process of considering actually posting county data, countywide data, as well as zip code level data. So we're hoping that comes out shortly.
Also, Kat would like to know how CRS is going to be impacted by risk rating 2.0.
So as I said, CRS continues. I think the major impact is what I said, since we no longer use zones. So the discounts get applied across the entire community regardless of zones.
Fantastic.
Biggest change.
What's the rationale behind the rate changes for risk rating 2.0 by month, since we calculate?
Well, some folks pay by month, basically through their lender. So we give by month and we give annually. So if you want the annual, we just multiply it by 12. So like I said, an $8 a month increase, you would just multiply that that way. So it's, you know, there is a division roughly half and half that pay in yearly and pay monthly.
So Bruce, we have a question for you on how the private market is responding to risk rating 2.0.
I think it's a kind of a wait and see. Now with you have 50 to 60 programs out there, the benefit is that they've been able to identify where, and different carriers are competitive in different areas. And not everybody's writing the stuff, like I said earlier, with hair on it, what have you. And some are writing only in specific geographic areas. So I think it's going to be a wait and see. I haven't, the ones I've talked to have not said, oh, we're all concerned that risk rating 2.0 is going to come out. So I think it's kind of a wait and see. But the private market is, you know, it's hard to estimate how much is out there. Some say about 10% of the policies out there, of flood policies, are private residential, not commercial. So we'll have to wait and see.
Very good. We have another question about the payment plan. You know, the HFIA, Bigger Water is one of them, authorized a monthly payment plan that's outside of escrow. Tony, do you have any idea when that'll be implemented, or if that'll be part of this?
I do not. Yeah, I do not know.
Okay.
Dave, do you have, Dave Stearrett? Do you have any update on that?
Yeah, so we are in the process of working payment plan. It is a priority for both federal insurance and for David Marsden to get that in place. It is something that's going to take some time.
Okay, and Tony, what is the maximum 1 year premium that somebody would pay?
I'm not quite, I get that, understand.
So under the current, under risk rating 2.0, what is the maximum premium someone could be charged under the current?
Family homeowner, $12,125.
That's under risk rating 2.0.
Yeah, under risk rating 1.0, there's people currently paying $45,000, and that will continue to increase, could go up into the 60s.
Right. The slides, they wonder if will be available for this session. I thought it's part of the recorded. You'll be able to record, look at the recording later. If the lowest floor relative to the BFE is not used, doesn't that cut the legs out from under promoting freeboard? I don't think so.
I don't think so.
well, no, Tony, because they get mitigation credits for elevating flood vents, putting your machinery and equipment above the first floor, et cetera. So elevation is still, actually, it has a credit.
Elevation is the biggest thing you can do. So elevating on post piles and piers, yes. Elevating your mechanicals, adding vents, those types of things, yes.
Yeah.
We have a very good question from Debbie. Equity in action. We have renters who are paying a $250 surcharge. Is that going to go away under risk rating 2.0?
No, it will not. That's a requirement in statute.
Okay.
But actually, Lisa, you know this probably better than I, but if it's their primary residence, renters only do a $25, correct?
They should.
Yeah, surcharge. So anyway, it's a surcharge.
Primary,
yeah, if it's a primary.
Yeah.
Is risk rating 2.0 going to provide payment assistance or grants to lower income customers and communities?
In 2018, FEMA provided an affordability study to Congress. Congress is the one that can do that and address affordability, and we continue to work with Congress on that. I wanted to also ask Dave Stearrett if he has any comments on that topic.
No, not beyond that. That captures that is something that would require Congress to get involved in. We currently don't have the authority in that space. We are in dialogue now with stakeholders on that, because there seems to be an appetite in some quarters to go after this in some manner.
And Tony, we have a question here. Will risk rating 2.0 algorithms become transparent enough that local floodplain managers and state coordinators will be able to provide quotes or saving suggestions to insureds on how to save money on their flood insurance or to calculate the premium?
Yeah, I guess the best way to answer this is flood insurance agents are the ones who are licensed, bonded, and responsible for that. So we want to lean more on those entities who are protected by their insurance and coverage. We need to come up with some sort of mechanism, I think, in the future to get estimates of some sort for those that are not agents. So that's basically my answer to that question. What we do need to remember is there's certain variables, which we have an engine, I think folks heard about that over previous years, that actually feed that rate. And they're based on a handful of inputs, and that gives us the rate. But basically agents should be the ones that are quoting, and we need to develop something in concert with floodplain management and others. Dave, do you have anything to add to that one?
No, I don't.
Okay. Thank you, Dave.
We have another question here. I've heard the National Flood Insurance program hasn't been solvent for a number of years. So if the majority of policyholders are seeing decreases, how are you going to generate the necessary funds to be self-sufficient?
So policyholders will see decreases in the first year. So that's one thing. Once we get through the decreases, the actual program does rebound. It takes roughly probably 3 years, 4 years till we start heading down that path to solvency, but it's going to be a long process. As you know, as I mentioned before, it'll take some folks 10, 15 years to pay their full risk rate. So it will take time, but we'll make progress over the years.
They're asking for zip code level detail on at the state level. And again, I don't think that's available yet, but I know you're working on it.
Yeah, zip code level and countywide data level, we're working on that now. So.
Yeah. How frequently will the models be updated, Tony, that you're using that are proprietary?
So there will be a regular refresh. It will typically be annually because the data sets come in annual. Our maps, those types of things are updated. Claims data, policy data, and the commercially available data gets updated. So we're looking at a yearly refresh.
Okay. And how will the letters of map change, either map amendments or letters of map revision involving fill or map revisions impact the rates?
So they're statutorily required, so they continue. There's no change to that. So they really won't impact the rates, so to speak. Any analysis that's incorporated from the FEMA data set goes into the rates, but it's just part of that factor. So.
The one person asked how levies are going to be impacted by the new rating system.
Actually, it's a very good question. I think most folks probably fear the levy question. Basically, what we found under the current pricing methodology, it's like a light switch. It's either on or off, you're in or out. Under the new process and under risk rating 2.0, the results aren't that much different than the national level. But what it does take into consideration is the actual level of protection. So 1,000-year gets more credit when it comes into it, or 500-year protection, or those partially certified, those types of things. So it's much more extensive. So it's more like a dimmer switch rather than a complete yay or nay. So it takes into consideration more variables of the levy.
And Tony, didn't David say yesterday that something like 90% of the building stock behind levees that you guys have know what that risk is now because of your working relationship with the Army Corps?
Yes, we work with the Army Corps of Engineers extensively. Initially, I can't remember the actual numbers. It was like 23% were certified and covered a certain percentage of homes. But then we worked with the Army Corps of Engineers and got up to the 47%, which covered 90% of the housing stock across the country. And we're very confident in those rates. So.
Tony, can you address how severe repetitive loss properties will be handled during the risk rating 2.0 process?
I'm not quite sure.
So are they still going to be charged the 25% increases, and will their rates be? Are there any changes to severe repetitive loss property the categories that right now we go back and look at the entire history of the claims? Is that going to change?
No. And Dave, do you have any updates on that one? I know Dave and flood insurance have the SRL component. I don't know if he's with us. So
I think Dave's here.
Yeah, so there are training materials that have been produced for the agents that address how the SRL properties will be treated. I was looking at those last night. To be honest with you, I cannot remember the details of exactly how, what's going to happen to the current SRL properties. But it is there. They are going to undergo some change. I just can't remember the details right now.
Thanks, Dave.
Thank you. Bill Brown would like to know that, as a floodplain manager, when he was working, the residents would bring in several different quotes from different agents that had different pricing for premium. Will risk rating 2.0 normalize that process, or will there still be room for variables on quoting for our agents?
That is a very, very good question. So the answer is no. You'll get one quote. So the difference between 2.0 and the current system is the engine and the quoting mechanism resides on FEMA's side of the house. So any agent will have to ATP in to the engine and provide the variables that were asked to get the quote. So it normalizes that process so you don't get wide ranges in quotes. However, they could ask one agent and they could change their total value of their policy. They could change their deductible. They can play in those realms to change their actual premium, but you can't change it other ways. No.
Very good. And the garbage in, garbage out, if the agent doesn't put in the right variables, the same variables as the other one did, then, you end up with two different quotes. So
yeah, you could actually do that. And I don't know the best, way around that. That's kind of licensing and then, someone's, honor into the system. But it could get caught if it bounces against previous information that we may have, or at claim time, that's a bad time to find that out, if you know what I mean. So if you noodle with the numbers up front and then at claim time, it doesn't match up, it's not true, then that's unfortunately when those things come to surface or come to light.
Brian wants to know where the sign was behind Bruce was taken. Where'd you find that sign at, Bruce?
That is, I believe this one back here.
Yeah.
I don't recall. I like some of you've collected these photos over the years, and when the world of Zoom started, the background of my office is a mess, so I just picked this one because my big bald head fits in it better.
So somebody wants to know if you're going to change your share, the fees that you pay, the percentage that you pay, Tony, the WIOs through this process.
Yeah, I won't take that question. I don't know if Dave wants to take it. That's a whole nother process.
I'm actually talking to the host now because he's turned my camera off and I can't get it back on. So audio only. Could you please repeat the question, Lisa?
Yes, they want to know if the fee that you pay the WIO, the commission you pay agents and the WIO will change under risk rating 2.0.
There is no plan to immediately change the fees. I know at a later time that's going to be studied. I think Congress asked us to do that, but that's a longer term effort.
Well, and as an agent, I can tell you if the rates are going down, our commissions are going down. So I think there will be some changes, in that overall, because it's a percentage basis. We have one more question here, and then we're going to move on. So maybe the messaging forward is that FPAs are not the people who, the floodplain assistants are the people that will not be serving currently to tell homeowners the rates, connections to floodplain management standards. Maybe just tell people to talk to their agents is very good advice.
Yeah, and if I could just add on that, Lisa. So, we realize there's angst with floodplain managers and others because, we're shifting from this paradigm, the old paradigm where we had the rating worksheet where folks that actually knew how to work the flood insurance manual and those variables could generate rates. And some floodplain managers did that in an effort to be helpful to insureds. the new paradigm is not going to allow them to have that kind of detail because the actual rating variables and things are in the engine. So I think as part of this, change is hard. And so it's hard to kind of like discuss with folks. They've been doing things a certain amount of time, 5, 10 years or more to help people, and that what they are going to undergo with the risk rating 2.0 is very different, and the type of assistance they're going to give folks is just going to be different in the risk rating 2.0 paradigm. It's probably going to be more general. Speaking of, of course, elevation still reigns supreme. Foundation type is very important. And there's the other variables that risk rating 2.0 uses. As said, we'd like to get to a place where we can give kind of ranges where floodplain managers can give folks information. If you elevate 1 foot, it may reduce your premium X percentage. But we're moving out of the system where they can actually calculate the exact amount, because of course the engine is going to be doing that. So they'll still be able to assist folks, but it will be a different type of assistance, and it will be less precise than some were able to provide under risk rating 1.0.
Very good. And Bruce noted the difference between coverage limits between the NFIP and private insurance. Tony or David, they want to know, does it take congressional legislation to increase the limits of the NFIP for coverage?
Short answer is yes. That's a congressional. The last time it was changed was in the 1990s, taking it to 250 for a single family residential building and 100,000 for contents. It's been a long time since the caps were raised, but that would require a statutory change by Congress.
Right. And the last question we have here before we go on our next presentation is, will homeowner be able to contact their agent and figure out which rate's going to be better? It'll be NFIP, the current rate, or risk rating 2.0. And I think we'll be able to do that in August, correct?
So what's going to occur is on as Tony described, on 1 October, new business will come in to risk rating 2.0. We're going to be providing a list of properties, and it's about 23, 24% of our book of business, who will most likely see a reduction in the risk rating 2.0 system. So we're going to be providing that list to the insurance companies and the vendors here in the coming weeks. And what will occur is, for folks that will benefit from risk rating 2.0, starting between 1 October and 1 April of next year, they will have the option of coming into 2.0 if it's more beneficial for their premium. And that is, it's going to be a phased approach. We anticipate that the companies may have to be catching people on the back end of this. They may not be prepared, quite honestly, to take care of all of this so-called opt-ins starting in October. But we do expect that a majority of them will be able to, a majority of that 23, 24% that are going to benefit will be able to come into that system. If by chance they aren't caught at the next renewal in 2022, they will be brought into the risk rating 2.0 system and be eligible for a pro rata refund for the previous year.
Very good. Well, we're having that, a lot of good questions we've had here, and I'll just reiterate, find an insurance agent that writes in your state and see if they can work with you to provide the quotes. If you're a floodplain manager and you want to learn more about the rating. Our final presentation is from David Stearrett of the Office of the Flood Insurance Advocate. David was a floodplain management branch chief prior to him being selected to fill the advocate's position. Before coming to FEMA, David worked in the North Carolina floodplain management program, and I've known David for a long time, as he was hired as my replacement when I became the South Carolina state coordinator. Rhonda Montgomery is the deputy flood insurance advocate, and she is also with us today. And she's been with FEMA for over 14 years and has served in a number of key positions. With this, I'm going to introduce David and let him begin his presentation. Thank you.
Hello, everyone. I'm Dave Stearrett, the flood insurance advocate for the National Flood Insurance Program. Today, Rhonda and I are going to discuss the Office of the Flood Insurance Advocate, or OFIA, and our role in helping FEMA and the NFIP be more customer-centric. As part of this effort, the OFIA releases an annual report identifying areas of confusion or frustration that customers brought to our attention. Through the annual report, the OFIA lists trends that we have identified and how we have worked with NFIP program elements to modify implementation to improve the overall customer experience. But before we go into the annual report, I'd like to take a few minutes to talk about private flood insurance options, which Bruce described, and Risk Rating 2.0, Equity in Action, that Tony talked about. In our discussions with customers, we do mention both NFIP insurance as well as possible private flood insurance options. We know that an insured survivor recovers more quickly and fully than a non-insured survivor. Sometimes private flood insurance is less expensive. We do ensure that the customers understand that going with the private policy may result in them losing an NFIP discount or subsidy should they decide to come back to the NFIP at a later time. With regard to Risk Rating 2.0, Equity in Action, it's gratifying to see that the NFIP's 50-year-old rating structure is finally being updated, taking into account new technology. Think about it. The basic rating structure was developed when Lyndon Johnson and Richard Nixon were president. It was cutting edge at the time, but it's definitely in need of a refresh. We're especially excited to see that the unintentional result of lower value structures subsidizing higher value structures will be corrected. Now that we're aware of this inequity, we have to update the rating system. It's just the right thing to do. The national level bar graph depicts the effects of Risk Rating 2.0 on current policyholders. I should note the distributions do change somewhat when we look at it at the state level, but most states are fairly close to the distribution you're seeing here. You'll see in the green bar that about 23% of policyholders nationally are actually going to see a decrease. The average decrease for those policyholders is going to be about $86 per year. 66% of the policyholders will see increases in the $0 to $10 a month range. This is essentially the increases that they've been undergoing for the last several years since BW12 and OFIA 2014. 7% will see their increases in the $10 to $20 a month range, and 4% will be $20 per month or more increase that they will see. Now, it's important to point out in this graph is 89% of our policyholders will essentially not see much of a change. They're either going to see a reduction, and they'll enjoy that reduction all at one time, or they're going to receive increases in line with what they've been undergoing the last several years. It's important to note the Risk Rating 2.0, if the rating system is not implemented, all policyholders under Risk Rating 1.0 will continue to see increases and none will see a reduction. The OFIA stands ready to assist the program in communicating to the NFIP customers about this more equitable rating structure. So with that, I'll turn it over to Rhonda to talk about OFIA's 5-year annual report.
Thanks, Dave. I appreciate it. And thanks for the words about Risk Rating 2.0 and private flood insurance. It's incredibly important to recognize that the Office of the Flood Insurance Advocate is a voice for the NFIP policyholder and property owner. So with that, I'm super excited to be here and visit with you all today about the OFIA 5 years of advocacy. And as we were looking at putting together the annual report this year, we really reflected on our role in FEMA and what we were able to accomplish over these last 5 years. So kind of taking us back down memory lane, some of you may even remember educating your elected officials, educating Congress about the need for FEMA to stand up a flood insurance advocate, and really the expectation that we had when the office was stood up. So, fast forwarding 5 years through our various annual reports, we really have a way of demonstrating the work that we've done on behalf of the policyholder and property owner, and actually documenting some of the progress the program office has made to reduce the complexity of the National Flood Insurance Program. So just a little bit of background about the office is essentially the office does three big things. We provide assistance to individual policyholders and property owners through our casework. We identify trends. Typically, this is around using the annual report, or we have periodic reports on our website that show the casework that we've done over a previous period of time. And then finally, we make recommendations to FEMA and FEMA leadership about challenges that our customers are facing that could be alleviated and support those programmatic improvements across the various scope of the National Flood Insurance Program. So just a little bit about how we do our casework. Essentially, if someone is frustrated or confused, a quick internet search through Office of the Flood Insurance Advocate will take you to FEMA's website, the Flood Insurance Advocate, and there at the bottom of the page is an Ask the Advocate button where the customer can push that button. They can submit through a form the question that they have for us or the frustration that they're experiencing. Once they submit that information to us, our office is notified. We actually have a courtesy notification that goes to the region as well. And then we start, as we fondly call it, working the case, right? But this is where we do the background work on it. We may get in touch with the region. In some situations, we actually call you all, the local floodplain administrator, to better understand the customer's situation. And then we evaluate how we can help them, right? So we may be able to find a different answer than they already had received, or we may validate the answer that they had already received from another reputable source. Either way, we take the time to explain to them their situation and help them understand first how they arrived where they are, but secondly, how to alleviate their concern. So perhaps they have a risk of flooding and they want to figure out how to reduce that. We can provide them with assistance and some of those additional resources that can tell them how to mitigate their risk in the future. And then with all of that, we collect data analytics on each of the cases. And then that data analytics gives us insight for additional policyholders, say, that haven't made it to our office, but may be experiencing that same frustration. So let's take just a little bit of a peek on our casework. So essentially, you'll see here that since our office became operational, our casework has been increasing steadily. So we have a slow trajectory up in our casework. We would like to think that that's because we've had opportunities, frankly, to visit with all of you, and just to make sure that you all know that our office exists and serves as a resource for your customers in your community, right? So those citizens in your community that might have questions about the National Flood Insurance Program or be confused about a situation that they're in. So the chart on the right, that kind of graph on the right, is a distribution of our caseworks by topic. What's important to note here, right, is the majority of the folks that come to us have questions about flood insurance, and that's great. What we also recognize is where they may have questions about flood insurance, they often also have questions about those other topics, say flood insurance and floodplain management, or flood insurance and their map, or how their risk is identified, or flood insurance and, say, a grant that might be available to them. So some of that is important, and we certainly note it through our casework. So fast forward, again, from that casework, every year we publish an annual report that really reflects on the previous year's work that we've done, and then also makes some program recommendations. So this year is our 5th year of producing these reports. The first 4 were just a look back at that previous year, but this year's report, the OFIA 5 Years of Advocacy, is really a retrospective of those previous years. So the OFIA 5 Years of Advocacy highlights our customer interaction. It highlights actually the recommendations that we've made and the program improvements, right, that have actually alleviated some of those customer concerns. And we can not only highlight the program progress, but we can actually measure it. So for those recommendations that we've made over the last 4 years, we've actually, of course, seen a reduction of 80% inquiries in those topic areas where the program has actually made a measurable change to alleviate that customer frustration. We just find that incredibly impactful. The 5 years of advocacy report also, of course, just provides transparency into the work that the office does. And then finally, we're continuing to support the ongoing improvements of the National Flood Insurance Program. So speaking of the recommendations that we've made in previous annual reports and the program highlights, these are just a few that we have chosen from our previous annual reports that really should be highlighted. The program should be commended for the forward-leaning approach that they took to our recommendations and really the thoughtful perspective that they put in to these recommendations and changes to the program to improve the experience of the customer. For instance, Federal Insurance Directorate expanded the eligibility for prior policy year refunds up to 5 years, and in many cases, the customer only received a one-year refund, where now that refund has been expanded to 5 years. A few other things is Federal Insurance and Risk Management Directorate work together on a common suite of outreach materials, particularly the outreach materials that are made available to the public at those public mapping meetings. That's incredibly important. It's important that a customer in Arkansas receive the same or similar information as a customer in Maine and a customer in Oregon, right? And just having a common suite of materials is incredibly important. Federal Insurance also allowed for a refund of the Homeowner Flood Insurance Affordability Act surcharge. And this is really in that situation where a customer was their home, the property that they were protecting with flood insurance, was considered a primary residence, but their surcharge reflected a non-primary residence. And so once that got corrected, they were eligible for that additional surcharge, and that's significant for those homeowners. And then finally, speaking of documentation required to prove your primary residence, Federal Insurance did ease some of those documentation requirements and make it easier for that customer to prove that the structure that they were living in is considered a primary residence, which does reduce their surcharge from $250 to that $25, which is a more fair surcharge if it is their primary residence. So looking ahead, while we recognize that this year's report doesn't go into the kind of what we call the deep dive of recommendations, there are still things that we need to pay attention to as we look beyond 2021. And of course, we're still hearing from our customers about some of these areas that they would like some relief in, particularly around installment plan options. We do know that the program is working to identify an avenue to ensure that installment plans are an option for customers, but we still note that customers would find relief with an installment plan option more similar to other lines of insurance. We're still hearing from customers around confusion around condominiums. We certainly applaud the program office for putting out some educational material around it. Customers still are a little confused about how much flood insurance they can purchase and, for instance, how much does the condominium association purchase and how to balance that out. And then, of course, there's unnumbered A zones, and this is customers that are looking for some premium relief in those unnumbered A zones and are still trying to find that. We do hear from customers who are struggling to access the hazard mitigation grants. And in this situation, what they're struggling with is convincing, say, the local community or the state to prioritize their project for a mitigation grant application. So we're still hearing from customers who would like access to those, but are still finding that just a little bit out of their reach. And then finally, we especially in, we've seen an increase in customers looking to refinance their structure. And when they do that, their lender may not understand or misunderstands some of the nuances around the mandatory requirement to purchase flood insurance. And so the customer, or in some cases the lender, actually comes to our office because they misunderstand what those requirements are. So those are just things that we're paying attention to as we continue to serve the NFIP customers, both policyholders and property owners. So this is just a little, what we like to call a word cloud, right? This is what customers have to say to us. So once we're done helping them and we answer their question, we do ask them for feedback on the customer service, and our customers let us know that they are grateful for the flood insurance advocate as a resource, and definitely feel like our staff take the time to hear from them, understand their situation, and provide them with some relief to keep going forward and mitigate that future risk. So how does the office go the extra mile? Every day, it is so important to us to provide world-class customer service for every customer that comes and seeks assistance from the Office of the Flood Insurance Advocate. But in some situations, we are able to really kind of knock it out of the park, if you will. We've helped customers avoid foreclosure because we've helped them better understand what flood insurance premium they're eligible for and have actually helped them reduce their flood insurance premium. We literally had a customer contact us who paid their flood insurance premium, but the payment hadn't gone through, and there was a hurricane circling in the Gulf. We were able to kind of track down where that payment was and actually got their flood insurance premium, their flood insurance policy reestablished before hurricane actually made landfall. And then on a regular occurrence, we help homeowners who fundamentally want to reduce their risk of flooding and protect that asset. And they contact our office and ask, what do I need to think about as I'm getting ready to mitigate my property and I'm trying to reduce my risk to flooding? We provide this guidance and technical assistance to our customers on a regular basis and really do feel like we are providing them with that world-class customer service and helping them reduce their risk, and we're incredibly proud of that. So, looking forward, you know, the FEMA has 4 core values: compassion, fairness, integrity, and respect. Those core values guide the Advocate's Office in the work that we do. But we also have a few other things that we absolutely hold true and that really continue to guide us in the work that we do. And that is remembering how important it is to maintain a customer-centric operation. We're here to serve the NFIP customer. The other thing that we do, and you've probably heard this many times, our office doesn't have any authority. So we can't ask the program office to go and change a decision. Instead, what we have to do is work collaboratively across FEMA and FEMA to help our NFIP policyholders and property owners. Again, that's so important to the work that we do. And the last thing is that to maintain our integrity of the office, we absolutely have to make evidence-based recommendations to reduce NFIP complexity. I mentioned this in the earlier slides. We do this through our data analytics and our casework, but we really take representing the voice of the customer incredibly seriously, And we do that through those evidence-based recommendations. So those are the three things that we hold true and as beacons for the work that we do. So from here, I'll pause and I'll open it up to questions, and I look forward to our live Q&A session. Thanks so much.
Thank you, David and Rhonda, for your presentation on the Office of Flood Insurance Advocate and the Risk Rating 2.0. We have a couple questions. Kate would like to know how we let more people know about the services from the Flood Insurance Advocate's office.
Kate, thanks for asking. That's a great question. We are going to continue to advertise the service of the Office of the Flood Insurance Advocate. We'll continue to attend the various floodplain management conferences and look to our stakeholders kind of outside of this world to ensure that folks know that our office does exist. So, so we are going to kind of keep pounding the pavement, if you will, to make sure that that everyone knows that we are a resource for those policyholders and property owners.
That's great. And has the Office of the Flood Insurance Advocate looked at how ICC, the $30,000 that's available during the claims process for one-time substantial damage or cumulative substantial damage, how that has impacted insurance claims and things like that, for future claims?
Sure. So we certainly recognize the challenges with a limitation of $30,000 for from ICC for mitigating structures. We actually do defer to the program office to raise those limits and kind of provide that additional relief to policyholders and property owners. Dave, did you want to add anything on the ICC piece from a programmatic perspective?
Yeah, we've certainly, ICC has been a recurring theme in our annual reports. It's recognized that it's a very complex process. The $30,000 in many instances is not adequate. There's been various efforts to increase that. We would need statutory help in that space from Congress in order to increase that. It is a complex process, but when it's worked properly, it's probably it's the quickest way to get a house elevated or mitigated, because I've seen ICC projects kicked in a matter of weeks or months, and whereas the grant programs take much longer.
And Tony, David, or Rhonda, can you tell us if FEMA is looking at a way of getting the money faster to homeowners who, after disaster, through the FEMA grant process, to mitigate, instead of going through? Sometimes it takes 3-4 years before they actually can start the project.
You mean the HMA grants, Lisa?
HMA grants, yes.
There are efforts at headquarters that are taking a look at that at a high level. I think it's recognized that there's need for improvement in that space. Well, I have the floor. I just wanted to there was a question earlier on how SRLs are going to be treated under Risk Rating 2.0, and SRLs are essentially going to stay on the current glide slope they are on now, the 25% per year. That's in statute. So only Congress could change that. The difference in Risk Rating 2.0 is now folks will actually know where their endpoint is. And when they get to that endpoint, they will no longer undergo those 25% increases. Currently, there's a small number of SRLs that have actually surpassed their actuarial rate. They're still on the glide slope because we don't have an elevation certificate on them. So they stay on the 25% per year increase. Under Risk Rating 2.0, when that Risk Rating 2.0 rate is achieved, they will stop on that path. So, okay.
And last comment I'm going to say here is someone said there's no fact sheet on the Flood Insurance Advocate's office on your website, so they'd like to see that added. I want to thank everyone today for their presentations, and if anyone has any closing comments, I think we have about a minute left.
Excellent. Well, I just want to express my gratitude to everyone who has taken the time to join us for today's incredibly important conversations. I appreciate everyone and all of the work they do to reduce disaster suffering across the nation and to continue the great efforts in floodplain management, flood insurance, and the mitigation efforts. So thank you. And thank you, Lisa, very much. And to all of my colleagues who joined on the panel today. Thanks.
What she said.
Absolutely.
Do you have any wrap-up
Yes,
remarks?
ditto.